The more this happens, guys, the more I'm just getting so sick and tired of it. But please, I just want the government out of my pocketbook. Get them out of my money. Please. That's all I want. And I think the average person in this country wants that same thing. And obviously wants their personal freedoms protected as well. But guys, it's getting a little dangerous. We're having some really big when it comes to like big wigs of the finance market, of the finance industry. We got like this guy Kevin O'Leary, which is a part of Shark Tank. We got Warren Buffett, and we got this guy. What is it? Michael Burry? Let me see. What is it? Yeah, Michael Burry. Sorry. Who he predicted the 2008 financial crash. And they're all sounding the alarm to a certain extent for all of them. About the U.S. economy coming to a pretty dangerous area. So we're going to go into it though, guys, because obviously when it comes to finances, we got to be a little bit aware of what the government's really going to be doing, and how much tighter are things going to be going, and do we even have a light at the end of the tunnel when they're really going to stop? But we're going to get into it, guys. All right. Happy Friday. We're going to have a great weekend. But before we do, let's smash that like button. Subscribe to the channel if you haven't already. But we're going to get right into it. All right, guys. But we got this here from the Daily Mail. Big short investor Michael Burry appears to bet on U.S. market crash with $1.6 billion position against the S&P 500 and NASDAQ indexes. Michael Burry, the money manager made famous in the book and film The Big Short, appears to be betting on a major downturn in the U.S. stock market. Burry held bearish positions against the S&P 500 and NASDAQ 100 index, worth a combined $1.6 billion at the end of the second quarter, according to securities filings released on Monday. The founder of Scion Asset Management bought put options against $739 million worth of shares in the popular Invesco QQQ Trust ETF during the quarter, and separate put options against $886 million worth of the SPDR S&P 500 ETF. Put options convey the right to sell shares at a fixed price in the future. They typically increase in value if the price of the underlying stock declines, making them a defensive bet. The dollar amounts of the positions refer to the value of the underlying securities, but the new filings do not reveal how much money Burry actually put on the line because they don't show the specific terms of the options he purchased. I mean, guys, this is just it's just dangerous. When we're talking, I mean, he's not just betting 100 mil. All right. And this is he's got a big management company. He's been doing this for a long time. So the amount of money that he has available to put these bets on, I mean, it's almost endless at this point. But 1.6 billion is a huge bet. I mean, that's a huge bet. And he bet correctly on the 2008 crash as well. So it's just not saying that he's 100% right, because not every position that he's taken has he been 100% correct, because that would be kind of insane. But his track record really isn't bad. And for him to predict the biggest recession that we had in 2008, that speaks volumes to just what he's seeing. All right. So something to just take in, not saying that we have to, listen to him like he's Jesus, obviously, but just obviously take in the context of his track record when it comes to that. So it definitely it matters, that's for sure. But the next one we have here, guys, this is from Yahoo Finance. As economic indicators shift, even seasoned investors like Warren Buffett are adjusting their outlook. In a recent announcement, the famed investor known as the Oracle of Omaha voiced his concerns about the state of the U.S. economy. During Berkshire Hathaway's annual meeting, he noted that the incredible period of growth for the U.S. economy seems to be slowing down, and that most of the company's businesses would likely report lower earnings this year compared to the previous year. Buffett's cautionary comments stand in stark contrast to his typically optimistic stance on the U.S. economy. So what's changed? A combination of persistently high inflation, rising interest rates, and an ongoing banking crisis have made Buffett and his longtime business partner Charlie Munger more cautious about the potential for investment gains in the coming year. Get used to making less, Munger remarked. Despite their pessimism, neither Buffett nor Munger are advocating for a complete retreat from the market. Instead, they suggest a few strategies for investors looking to navigate the shifting economic landscape. And again, guys, this is Warren Buffett is not an extreme guy. He's not going to be like, oh, yeah, everything's falling apart. He's not going to do that when it comes to the economy. He knows how the economy works. He knows there's ebbs and flows to the stock market and to making money and not making money. And he just knows the cyclical nature of finances. But for him to come out and say this, that means he is definitely seeing some problems that we're going to be running into. And obviously us as everyday Americans, we've been seeing the problem in our groceries and the cost of gas and the cost of basically everything has just gone up. Even my gym membership, like, it's a service and you're making it go up. Like, it's just ridiculous, guys. So, I mean, everything's going up. So we've been seeing it, but for the big wigs, the elite people that don't see the average, struggles when it comes to the economy, this is big because now they're a little bit more hesitant about what's going to be happening. All right. And we got one more. Again, this is from Kevin OLeary, and this is from Yahoo Finance as well. And Kevin OLeary is worried about a crisis emerging in the United States. In a recent interview on Fox Business, the entrepreneur and television personality was asked if the small and mid-sized businesses he works with are becoming more optimistic about the economy. And he says down here, no, that's not what I hear, and I live in the real world, he said. OLeary expressed his concerns with rising interest rates, and with further rate hikes on the table, he worries it could push some businesses into deep distress. Small business optimism ticked up recently. The National Federation of Independent Businesses Small Business Optimism Index increased 0.9 points in July to 91.9, although that's still lower than the 49-year average of 98. OLeary believes the numbers mask a deeper issue. We have a crisis emerging, he said, referring to the 10 consecutive interest rate hikes the Federal Reserve has imposed since March 2022. These rapid rate hikes that have occurred and the unprecedented speed of these hikes has put my small businesses in a difficult position. The cost of capital has gone through the roof. OLeary believes smaller companies are particularly vulnerable. If you're in the S&P 500, you have no trouble financing your business, he said. You can't say that about small businesses anymore, which is completely true. He goes on to highlight the fact that small businesses with 5 to 500 employees represent 60% of the U.S. economy, which is why this liquidity crunch is a concern. We've got a real crisis coming here, he said. When the Fed raises rates another 50 basis points, that's going to make it worse. And again, guys, he's not lying at all. This is, I think the media has done a disservice to the American people. Obviously, they've been doing that, but they've really been doing that when it comes to the economy, because this economy, guys, is hanging on by a very thin margin. And our economy, when it comes to the everyday things, the groceries, the gas, the things that everyday people care about, right? The cost to buy a home, the cost of rent, all that stuff. We're in a recession based on the numbers that we're having to pay. But for some reason, these big corporations, and it's not for some reason, we already know, but these big corporations, they're able to stay afloat and they have no problem staying afloat. Yeah, are they making a little bit less profit? Yeah, maybe. But they're the ones keeping the stock market afloat, and that's what everyone's looking at when it comes to is the economy going to crash? And it's already been crashing for the everyday American. So that's why I've been saying we're going to be in for a wild ride, because I'm telling you guys, whatever happens in the real world, like if they pass a new law, if we have the COVID lockdowns where they give us all that money, all that stuff, it takes a solid year or so before you start seeing the domino effect of those decisions. And I think we're kind of starting to hit the uphill trajectory of things really going to shit, if you don't mind me using that language. And it's just very concerning, guys, because things are already super expensive. And if the economy gets worse, if things do crash, everything is going to go through the roof. I mean, through the roof, guys. And it's already through the roof. So that's just why I'm saying it's very important that we pay attention to who the hell we're voting for and who we're electing, because it matters, guys. Like, I don't care about having a beer with my president or my congressman or congresswoman or my senator. Okay, I really don't. I care about you getting the job done and voting based on how your constituents in your district or your state uh, voted you to vote. They voted you in to vote a certain way. So it's just, we got to hold our politicians accountable, and I'm hoping that with how crazy just the culture in the United States has gotten, how crazy the economy's gotten, just how crazy everything's gotten, it's kind of waking more and more people up. And good people can't stay quiet no more, guys. I mean, at the end of the day, good people cannot stay quiet no more, or else we're going to be in for a hell of a ride. But we got this little clip here too, and this is going to be from CNBC, and it's just, this is a market expert. And I think Jonathan Liang, he's a JP Morgan asset management. So he helps control or helps run the JP Morgan asset management side of things. And he kind of gives a rundown on what he's seeing. And he really gives a lot of good detail. And he's seeing a recession by the end of this year going into next year. So let's watch this and see what we got. If it'll play.
Baked in the cake, pre-consensus. So the language is really going to be very important in what we think is going to happen in the future beyond this week's meeting. And we think the Fed is probably going to try their best to maintain a certain degree of so-called optionality for themselves so that they can potentially have more policy flexibility in September. They're going to they will probably likely remark on the recent slowdown in jobs numbers, as well, obviously the inflation data. Headline CPI in the U.S. is now running at 3%, still above their target, of course. And of course, core CPI is actually slightly higher than that. So we think that the direction of travel for inflation, they will probably remark that is encouraging, but perhaps the speed is not yet to their liking, so they want to preserve that policy optionality.
So some of the data points have edged lower. What about the economy? Are we getting set for a recession in the United States? And if that happens, when do you expect the policy pivot to take place?
So we think that the U.S. economy today, on several fronts, is actually still quite resilient. For example, the labor market is still very strong. Household savings today still being artificially lifted by the COVID stimulus checks that were written in 2020. And so household balance sheets are still in decent shape, but they are starting to deteriorate. Based on the current trajectory, that excess savings from COVID stimulus will probably run out to the third quarter, fourth quarter of this year. So we think that the U.S., however, we think is probably likely headed to a recession towards the end of this year, start of 2024. We think the primary driving force of that is going to be tightening credit conditions, as bank balance sheets, particularly among U.S. regionals, remain somewhat flawed and still have to be repaired in order to get bank lending going again. So we think that the drying up of credit conditions will be what will bring the U.S. to a recession at the end of this year, start of next year.
I mean, guys, that's just what I'm talking about. They're saying it's coming by the end of this year, going into next year. These are people that this is their profession, looking at the numbers, looking at the financial industry and seeing what's going on, seeing what the economy is doing. It's not a good look. It's not a good look, and it's gonna really hurt. And the Fed is gonna keep raising rates, like they said. The Fed has not shut down. They have not said in their last press conference, they did not say that they're not raising rates anymore. And if they haven't said that, that means we're going to see the interest rates keep climbing. So these 7% interest rates we're seeing are going to go up to 8. They're probably, and honestly, unless the economy really comes to a standstill, they're not going to stop. They're not going to stop until we're actually in like a real recession. Like, that's what they want. That's why they're raising the interest rates, to get everybody to stop spending money. They want the economy to come to a halt to bring down inflation. But the market is so super inflated with just other things going on. it's really weird how it's still staying as afloat as it is. Because I don't know anybody who is really living comfortably that's making under $100,000 a year. I don't. Like, even making $80,000 to $90,000 a year, you're barely able to save any type of money. Barely. I mean, it's just absolutely insane, guys. So we just got to stay on top of it, all right? And just be aware of what's going on. Let everybody else know what's going on. That's why I started the podcast. So if you like this episode, if you think that anybody that you know can get something out of it, and just allow them to be aware, and just allow them to know that there's a lot of average everyday Americans that feel the same way and are seeing these things. You know what I mean? I'm just an everyday guy. It's not like I get paid for this yet. We're trying to get there, guys, but I don't get paid for this yet. I do this because I'm already looking at this information, and I think it's helpful to have another voice from just the everyday walks of life that can kind of break it down a little bit easier than someone who looks at this stuff professionally. So again, guys, I appreciate you. Make sure we smash that like button, subscribe to the channel if we haven't already. But again, I hope you have a great Friday. Enjoy your extended weekend. We got a Labor Day, I think, is what we got. So we got Monday off. So everybody enjoy it, and I'll see you on that next video.